Investors often ask, what's the difference between an active ETF and an active mutual fund? They sound similar, but they operate quite differently. And those differences can really matter depending on how you invest. Let's break it down. An active mutual fund, often called in the UK an open-ended investment company, is the traditional approach. A fund manager buys and sells investments aiming to beat a benchmark. These funds are typically bought directly from a provider or a platform, and they're priced once a day. An active ETF works on the same principle, active management, but it's structured like a regular ETF. The ETF will often use more quantitative models in order to make investment decisions. Number 1. Trading and access. Mutual funds trade once per day, but ETFs can be traded anytime the market is open. This gives more flexibility, especially in volatile markets. Number 2. Transparency. Active mutual funds may not disclose their holdings regularly or even at all, but typically just monthly. Active ETFs generally publish their holdings daily, and that helps investors understand what they own in real time. Number 3. Fees. Active mutual funds tend to have higher fees, sometimes up to 1% or even more. Active ETFs usually have lower ongoing charges, thanks to a more streamlined structure. Think 0.2% to 0.6%. It depends on your needs. If you want intraday flexibility, lower fees, and more transparency, active ETFs are a strong option. If you're already invested in mutual funds via a pension or a workplace scheme, those may still make sense for you. But for most modern investors, especially those using platforms like InvestEngine, active ETFs offer a more flexible, lower-cost way to access active management. They're also easier to integrate into portfolios with automatic investing, rebalancing, and savings plans. The important thing is knowing what you're buying and why, and making sure it fits your investment goals.